Back with episode 2 of the podcast. We are going to address today of some big themes in the last couple of years that I've picked up with respect to investing in companies that have the cream of the crop when it comes to companies with the ability to grow their earnings power at very unusual rates for very long periods of time. Now, I want to talk about this in two specific kind of ways. The first one would be in terms of companies that are in their, let's call it their first act, or, to use a more interesting term, call it names in play. But basically, over the last couple of years, found it a lot more interesting to go after companies that are in, what we would call unusual situations. And there's been a couple of these over the years that typically are incredibly rare, not a lot of ability to, they are extremely rare, and it's very difficult to go and identify a large number of these at the same time. But if you're a smaller investor, which could be probably the market cap of some of these companies was in the hundreds of millions. So, you can probably get tens of millions into, a strategy like this, as opposed to, hundreds of thousands or single digit millions. But basically there's been very few of these over the years. And, historically, a number of these have, popped up at strange times as well. But basically what we're talking about is the holy grail of what we're looking for with respect to going after companies that have an extraordinary ability to grow their earnings power for a long period of time, which is extraordinarily rare. Anyone who has been managing their own money for a while will know, how strange, how hard, how difficult it is to go and identify names that have the ability to grow earnings power very strongly and predictably over a very long period of time, and then to also get that situation at a time when the valuation is very appealing. That's a very strange set of circumstances that don't come around a lot. The more common case that tends to come up is that you're looking at a relatively well-covered company that may have secular strong tailwinds and may have a reasonably good valuation. This is a kind of idea that's been floated around with the FANG names now for a long period of time. There's probably a short period in the early 2010s when a number of these companies traded for multiples which didn't even remotely reflect their earning power ability going forward. But for the most part, these are very rare. It's a very rare circumstance that something like Amazon or Google or even Meta, gets down to a single digit earnings multiple, or even, a low teens multiple. It's very rare. And so, this brings me to the idea of why am I getting such a good deal? This is one of those questions which is, incredibly important to answer when you're going after some of these things. And, there are a couple of good answers as to why you might be getting a really good deal. The first reason you might be getting a very good deal is liquidity. There might be even though the market cap of a company might be quite, decent in terms of, a small cap or mid cap, whatever it may be, for one reason or another, there may be very limited liquidity. Limited liquidity precludes a large number of investment operations from getting involved. So usually, even if someone, professionally, if people are running a small or mid cap strategy, unless there's a certain amount of daily liquidity, many of those funds cannot look at it. So even if it was interesting, even if it did meet their criteria for business quality, etc., doesn't matter. There's not enough liquidity. So they cannot get involved. And that's for reasons we won't get into here. But, that is a reason why companies with fairly low liquidity, let's say $50,000 to $500,000 a day in terms of turnover, if a company has liquidity like that, it's a complete write-off for large amounts of smart money. And that's why sometimes you find very good opportunities where there's limited liquidity. That's not always the case. I don't want to say that. Sometimes awful liquidity can be associated with a number of very negative characteristics as well. So you don't want to go after illiquidity as a characteristic, but lack of liquidity in a certain name can be a premise, for why you're getting such a good deal. Another one would be, strange corporate situations. So this can either be a coming to market in terms of a company that's IPOing, having a direct listing, what have you. It could be getting spun out. There can be, a corporate demerger happening as well. Those are typically very good places to go and look for businesses. And this is probably another reason why it's very helpful to be, generally interested in business and always looking around for businesses that might be quite interesting, because these corporate actions happen on a regular basis. And I've covered a number of them on the newsletter. There's the Duff and Phelps spin as well as the Moody spin, which were both really good opportunities in terms of a corporate action that was married up with a very high quality business. Thirdly, there's probably, obscurity for reasons, that it can be mysterious. From time to time, certain companies lack any kind of coverage for reasons which I can't explain. Like we were talking about FICO last week, and FICO had no sell side coverage until I think 2022 or 2023, which is it's inexplicable to me. Like it's inexplicable how a mandated credit score, and that mandate began in 1994. So for almost 30 years, this company had zeros. Well, not for the entirety of the 30 years, but at least for the last 5 years preceding 2022, it had no sell side coverage, which is bonkers. That's crazy. But that also happens. And that's also a reason, why something might be mispriced. Quite often things can, they can move in and out of index inclusion, which can make them difficult for large swathes of the market to follow them. If something is not involved in an index, it might not get any coverage at all. And quite often corporate actions can happen underneath the covers. While these things are sort of falling from public focus. And if that's the case, they can also be mispriced at a time when, things are happening underneath the cover. So that's actually, FICO is also a pretty good example of that. It had pretty interesting changes to its pricing power occur at a time when it had very limited, if not zero sell side coverage. Bizarre and strange. So those are probably three fairly good reasons, why you might find a really good bargain. Typically, there will be discrete periods where markets can generally become undervalued. This can happen at either an industry or a company specific or even a general market level. So obviously the 2008 period, almost everything was cheap. The early 2010s was fairly cheap. A growth market. Those things have been less and less true since then. So both of those are, there can be a combination of these, characteristics as well. It can be true that there can be strange securities attached to some of these companies as well, which also makes it very difficult. Not difficult is probably not the right word, but inconvenient for them to be valued. And a pretty good example of that has been the Tel Aviv Stock Exchange. Over the last 5 or 6 years, it was spun out into public ownership midway through 2019, and it had a number of very strange things around it, which obscured large parts of its valuation for quite a number of years. Firstly, it was spun out into public markets by an act of the Israeli legislature. With the consent of its regulator. Now, that's like a very strange thing in and of itself. The history of most stock exchanges is that they were, what's known as mutuals or mutually owned. In the case of the stock exchanges, most of them were owned by people who owned a seat on them. And so this goes back many decades, but for the longest period, for a broker to trade on a stock exchange, they had to own a physical seat in the stock exchange. And so that could be rented out to people. It could be leased. You could have an employee of your firm sit in that seat if your firm owned that seat. That was basically the right for someone to go onto the floor of the stock exchange and deal in the securities that were being traded. And so along with the ownership of this seat, obviously a number of rights, but basically a lot of these exchanges were owned by the people who were trading these markets on a day-to-day basis, whether that be individuals, I think, they used to call them locals, or whether it be an institutional body that was running a brokering operation. And so over time, this idea of mutual ownership is an old one. In the last 50 years or so, there's been a wave of quote unquote demutualizations of a lot of these kind of bodies. These could have been banks, community banks, credit unions, various financial infrastructure seem to work this way as well. But with the privatization efforts of the neoliberals of the in the late 20th, early 21st century, many of these things became proper public companies. And so a strange thing about Israel generally is that they've just been decades behind the rest of the West in kind of having this kind of private ownership of some of their financial infrastructure, and so that's been quite a bizarre thing. For the Tel Aviv Stock Exchange itself, for the most part, it was mutually owned by the leading banking interests. So in Israel, there are about 4 or 5 very large banks, and for the most part, these are kind of stodgy old school institutions, not particularly dynamic. Anyone who lives in a country that operates under a banking oligopoly, so definitely be Australia, Canada, maybe the United Kingdom, definitely parts of Europe, where a banking oligopoly, which has basically a cost of capital advantage due to government sponsorship. Basically, these are institutions which are not particularly dynamic or responsive to the needs of the people who live in these countries. And so in Israel specifically, legislative and regulatory action was taken to get some of these key assets outside of bank ownership, because the banks were basically making it very difficult for these key pieces of financial infrastructure to operate in a modern way. And we can explain some of that later. But again, that's a very strange situation. It's very strange that actually a legislative or executive body would come out and force this basically to happen. In the West, generally, these things have been done largely via the free market, although in conjunction with the regulatory authorities. Key financial infrastructure is always heavily regulated. So that was the first thing that was very strange. The second thing that was very strange, of course, was how this public ownership was affected. So I can use the Australian Stock Exchange as an example, but when it was demutualized, so those people who owned seats on the stock exchange, they had their seats converted into equity. The value of those seats was converted into equity. And a similar thing happened with TASE, or Tel Aviv Stock Exchange, where people who owned a seat, they had for the most part those that ownership converted into an equity position, and the banks themselves, so these 4 or 5 large banks, they also had their stake converted into equity. It was partially diluted, and they were also given a separate form of equity, a different form of equity than the other equity holders and the equity that was sold onto the public. The equity that the large financial institutions had was something called arrangement shares, and those arrangement shares had a capped value. So this is like a very interesting example of some very odd securities that had very interesting implications for both TASE as a financial institution in and of itself, and the people who picked up equity. So these arrangement shares had a capped value. I'm not going to get into what they were capped at. If you want to read about that, you can hop over to the Substack. But they effectively had a capped value, which was pretty modest in respect to what the company was listed at, and then when it went on to be worth. So over a certain amount, the value of those shares would be captured by TASE itself. So when the bank wanted or was forced to sell their equity positions, they would capture the capped value, and then anything above that was sold would then be returned to the Tel Aviv Stock Exchange as cash proceeds, and they would have to use that towards their capital expenditure. So this is like a very interesting game theory scenario, basically, where TASE itself as a corporate entity and its minority shareholders, or those shareholders who own shares that were not arrangement shares, they were kind of long their own stock. TASE was almost long its own stock because it was capturing the upside of about 20% or so of its own shares. Now, the proceeds above the capped value would have to be put towards capex, which is fine. All money spends the same. So long as there were intelligent things to do with that money, it's completely fine. Basically, writing down your capital expenditures for a number of years. This presented a dilemma for the 4 large banks. They had very little in the way of incentive to sell these shares, as you might imagine. Sure, they could go and sell the shares as quickly as possible and realize their capped value, but there were other things happening at the time. So Taze issued a dividend, and Taze also was repurchasing shares. It was repurchasing normal equity that were not the arrangement shares. And so in this context, while Taze was returning capital, they really didn't have much incentive to sell the shares while they were doing that. Can continue to collect the cash proceeds, because selling it means that you can no longer collect the cash proceeds, and that your benefit from selling the shares from a pure equity standpoint there's not a lot of incentive for you to do that. So this was kind of, for several years on and off, this was a cat and mouse game between these 4 large Israeli banks and Taze themselves. Taze wanted to get rid of the banks as shareholders, as you think they might, as the shares went on to appreciate, and we'll get into the reason for that a little bit later. They wanted to realize the upside in this equity position they had in the arrangement shares. Banks obviously didn't care about selling. They can continue to collect their dividends, and actually their equity position might get stronger while the company was repurchasing shares hand over fist. Now, if you know anything about the 4 large Israeli banks, again, calling them dynamic would be a lie. Not particularly forthcoming or forward-looking or dynamic or anything like that. So it took a lot of arm wrangling, basically 3 or 4 years after the IPO, for these arrangement shares to basically get worked out. But it presented a very interesting opportunity in the interim, because that 20% of shares that were held in arrangement, that was you could pretty reasonably discount that from enterprise value, because there was cash going to be returned to the company, and eventually that would make its way through to the shareholders by Xing out capital expenditures for a number of years. Obviously, some portion of that could not be contributed to enterprise value because the banks had a stake in that. Probably the other thing to mention from the enterprise value level is that strangely enough, Tel Aviv Stock Exchange owned the building that the exchange operated out of, which was also a fairly decent portion of the market cap at the time. So you had a very bizarre equity position in the company, these strange securities, which were it was a little bit unclear about how it would be resolved. On the other hand, there was a fixed asset that the company might be able to go and sell, realize the cash, and then lease back the facility to themselves. Now, in the former case, Taze had to go and get several corporate lawyers involved and basically threaten the banks, saying that they had a strong case for saying that the buybacks and the dividends that had been issued actually deducted from the capped value of their equity. So they were basically going to say, we're going to zero out your equity position in the arrangement shares by dividending and repurchasing the shares until your capped value goes to 0. And then on the other hand, the regulators got involved and encouraged the banks to come to a deal. And then eventually, they came to a deal, the banks and Taze themselves, where Taze paid out a very large one-time dividend, something in the order of about 12% of the market cap at the time. And so the banks were effectively, paid off. They were basically paid to sell their shares. And then the arrangement shares could be redeemed by the company, and they could restructure, and it could have a much more normal corporate identity, which is exactly what they've done. And that also worked out fine for the minority shareholders, because they were also able to realize a large cash return within 3 or 4 years of the company going public. So that worked out great. But in the interim, and certainly while several other things were happening, the valuation of the company was very obscured. So we've addressed this first piece, which is the strange corporate structure and deals, and the deal of the IPO, which made it very unfamiliar. Secondly, in a bit of an unfamiliar market. So Israel, you definitely call it Western, but it is not the United States of America, and it's not Europe. This is a place that operates within a very fluid legal system, and there's been fairly consistent political intrigues and various different tensions there, and obviously they exist in a part of the world where there are significant geopolitical tensions right on their borders and inside their borders, for that matter. So it was also very very a strange thing for large portions of foreign capital looking at the market. Israel themselves, like most emerging capitalist democracies, I think it's fair to call them a capitalist democracy, but there's no great culture of equity ownership for the most part. This is a place where Tel Aviv real estate will trade at similar multiples of median income that might be seen in Sydney or Los Angeles or New York. You're getting to kind of those levels. People resonate with hard assets as opposed to equity. And so you have this very strange dichotomy where the business assets are trading at, we're trading at rock bottom valuations compared to real estate, which was trading at, very high valuations. So certainly wealth there, but, a corporate and financial culture that didn't very strongly believe in equity, which is, that's fairly common for places that are developing or are in an earlier stage of development than more of the advanced democracies. It also goes without saying that on October 7th, 2023, terrible atrocity occurred, which broke out a war, which kicked off a number of speculations or approaches to Israel themselves, which was not necessarily reflecting economic reality. At the time, plenty of Western institutional money managers were pulling money out of that market, partially because of the geopolitical instability, also partially due to some of these ESG concerns around Israel themselves, which if you were following any of these companies and listening to their earnings calls and those kind of things, or even just reading the financial results, you would know that what was happening from a signaling perspective by Western democracies did not reflect financial reality on the ground, even though huge portions of the population were mobilized in that particular conflict, and for the most part still are, even though it's being resolved. So you had a sort of confluence of these figures, right? And that were, you could call it suppressing valuations, but certainly presented, domestic and international investors with a number of circumstances which, were very strange and odd and unfamiliar, happening simultaneously, along with these things that were altering perceptions, was just great and fantastic business performance. So as I mentioned before, Taze itself, was a very under-monetized asset simply for the reason that it wasn't run particularly well for a very long period of time. It's mutually owned by, the large Israeli financial interests. And those, there wasn't a great incentive behind the people running the exchange or for the banks themselves, to go out there and do things like, market the exchange, to foreign capital, or create different types of indices, or, roll out co-location facilities or anything like that. So, they weren't even charging companies to come in and, ring the bell on their first day of trading when they listed on the Tel Aviv Stock Exchange. There were all these things, that they just, weren't doing. They were, literally decades behind Euronext or NYSE or even the ASX. They're just a very, very long way behind what was common practice elsewhere. So exchanges themselves, monopoly regional exchanges are good businesses. There's no doubt about that. There's a network effect there. Typically in a sort of regional, you could call it a regional market, somewhere in Europe or let's say Israel or Canada or Australia, these West or Japan for that matter, or China, these kind of peripheral markets around the US, they present they have a strong proposition for domestic companies, especially those domestic companies which are not international. If you're a very high quality international business that might have started in Sydney, but then scaled globally, or even just scaled to the United States, your preference is going to be to list on NASDAQ or NYSE. The reason for that is that's the deepest capital markets. Your cost of capital will be lower there. And, you might have significant operations in the United States. And so, having your listing where the majority or a very large part of your business is just going to make sense. Probably going to, relocate the company there over time. So there are very well-known, well-established advantages to having an American or, North American listing, just for very simple reasons. But in these peripheral markets, there are a large number of of bricks and mortar, ma and pa type businesses, which have strong domestic positions, who would not necessarily benefit from a US listing, and maybe they don't make enough money for that to really make sense. But they will still want to list on an exchange somewhere for the ability to raise equity capital, and as a derivative of that, might raise debt financing as well. Typically, what you find outside of the United States is not a very strong culture for cash flow lending, or not lending against things which aren't hard assets. And so in a particular situation like that, this is especially true in Australia. You're going to want to list your business on the domestic exchange because equity capital is actually, one, available, and two, is not going to need, you're not going to have the onerous restrictions put on you that you will be from raising debt finance. There's several companies in Australia which have billions of Australian dollars in revenue who even to this day can't really borrow a lot of money without putting up a hard asset as collateral. Now, you ever talk to anyone in America about this and they think you're crazy, but this is just the situation that we're in. So these, domestic exchanges have, they have a strong proposition towards domestic companies that need to raise capital. A typical network effect takes place where, even in the domestic sense, you need to go to the place with the most number of listings because that's where, most of the capital is going to accrue to, and you will end up having the lowest cost of capital in a domestic sense. These things often also have a government license or sanction. A government isn't going to necessarily license a large number of these. That can make financial regulation difficult, and so they won't necessarily want to do that. And the history has been that for the last 50 or so years, many companies have been, many exchanges have been consolidating. This has definitely been the case in North America. This has been the case in Australia. I'm sure it's the case in Canada and the UK as well. Although in the UK they have opened things like the AIM market in the last couple of decades. So there's a very strong domestic network effect happening there. And typically some of these exchanges can have EBITDA margins north of 50 or 60%, something like that. And there's a number of reasons, for that. Obviously, these exchanges benefit from transaction volumes, but it's probably fairer to say that most exchanges resemble a software business today rather than a pure exchange business. And this is because they monetize things like feeds. So if you want real-time feeds, that's like a subscription cost that comes out, and typically that's very expensive, and they raise the price of it every year because people need it and they can't go without it, and there's only one place to get it. And you have a number of these things. So, before Taze was a public company, they did not offer co-location facilities. Co-location has been a big thing in the United States for at least 10 or 15 years, where people want to get their servers as close to the market physically as possible as they can, so they can have the lowest latency when they're doing things like high frequency trading. Taze had at least one hidden asset, which was very different than most other Western equity exchanges, in that they are the forum for the Israeli government raising debt finance. They also basically run the domestic market for bonds, bills, and debt financing as well. So that presents a very different kind of proposition than a typical equity exchange, which doesn't have those products. And having basically a monopoly on the government raising debt financing in the kind of current environment that we're in, where countries, corporates, and individuals have been getting more and more indebted for basically the entirety of the post-war period. That's also a very strong position to be in. And as it turned out for them, it was basically a hedge on their equity business. When the equity markets were doing poorly in terms of issuance and trading volumes during the recent war, the government needed to raise significant debt financing to fund that war. And so you kind of have a multi-exposure to different geopolitical outcomes. Which was, very unexpected. But basically, what you had was a very under-monetized, under-commercialized asset, which had some very strange characteristics to it, which meant that it had, a much lower valuation than its typical peers. And certainly it had a lot of economic goodwill on its balance sheet, that it was able to raise prices, roll out new products at very high incremental margins. And those things rolled over into, very strong top line performance over the years, and then a lot of operational leverage. So the operating income growth, EPS growth, all those sort of things has been fantastic. At the same time, while these things have not required a lot of capital, talking about their commercial efforts, while those things have not required a lot of capital, it meant that they were able to actually return a lot of capital. So again, when the war broke out, they were in the market returning capital every day through an open market buyback program. There's been dividends issued over the years. There was a one-time special dividend of 12.5% of the market cap. Recently, they've announced that they, facilitated a block trade of about 4 or 5% of the equity outstanding from an individual owner, at a great price for them and pretty decent price for continuing shareholders. So you really had kind of, like the best of all worlds. You've had, an obscured valuation due to, very strange things happening from a corporate perspective. You had very strong business performance, which has not required a lot of capital. And in fact, some of these capital expenses have been covered by some of these strange equity assets. And then, on the other side, because the business is so cash generative, and as it's turned out, it's fairly well hedged against different geopolitical outcomes, been able to return a large portion of that capital to shareholders along the way, and the results have been fantastic. So this is kind of what I'm talking about with respect to, first acts or names that are in play. There'll be businesses from time to time that are, in a very strong position to perform really well from a financial standpoint for quite a long period of time. And these don't last forever. So there would have been a period of time when, Johnson & Johnson or Procter & Gamble or Hershey's, where they were really kicking the lights out in terms of taking advantage, of white space or a large market or large pricing opportunity. And today, those things they're not true. These are single digit growers, good businesses with economic goodwill on their balance sheet. But you have to expect over time that share price returns will coincide with the increase in intrinsic value, and the increases in intrinsic value are tied to earnings power. And so if something only has the ability to grow its earnings power at very low multiples, even if you are able to buy it at a what looks like a great valuation, sometimes those things don't work out in a very good fashion. And so things like the Tel Aviv Stock Exchange, which are good businesses, but are under commercialized and certainly underpricing their products, that presents like a fantastic opportunity to participate in its growth in earnings power as they go out and roll out things that have already been done before. And so that would kind of feed into this idea of a name in play. Is this a company that's in a position to sustainably and predictably grow its earnings power at a fantastic rate for a very long, perhaps indeterminate period of time? And so then that ties in to this idea of why are you getting it at a great price? So it's certainly true that, if something is in a place to produce a lot of growth with not a lot of investment and the ability to return a lot of that cash to shareholders in various ways, you can pay what would seem to be a high price for those. Obviously, the higher the price you pay, the less your return will be and the more risk you take on. But it's sort of the marriage of those two, which can really lead to the proverbial home run. So yeah, look, that's a quick overview of what happened at Taze, a quick overview of a situation that can be very interesting to follow and try and replicate that in different forms. And I've given the example of Taze, written about it at length, continue to write about it as it's still performing fantastically well and bootstrapping a lot of value into itself. So if you want to check out that in more detail, I'll put the link to the Substack in the notes. Thanks, guys.